Hi, everyone. Welcome to today's deep dive. We're going to explore how investors, the people who own parts of companies, can actually influence what those companies do. It's a really dynamic and debated area.
Absolutely. We'll focus on two major ways investors try to make their voice heard or, exert pressure. One is often called active ownership, which generally means engaging directly with the company.
Okay.
The other is divestment, which is selling shares, often with a very specific public statement behind it.
Right. So our goal is to understand the nuts and bolts of how these strategies work, look at the arguments for and against their effectiveness, and really dive into a high-profile example, the fossil fuel divestment movement.
Exactly. We'll pull back the curtain on the mechanics, look at the powerful stories and ideas that drive campaigns like the fossil fuel one, and see what the latest evidence suggests about their real-world impact.
Okay, let's unpack this. First, maybe let's just set the scene by quickly clarifying the difference between active and passive investors.
Yeah.
Why does that distinction matter when we think about influencing companies?
Well, it's a pretty fundamental difference. Active managers are, actively picking stocks or bonds, doing deep research, trading on information they find, all with the aim of beating a market benchmark.
Trying to outperform.
Precisely. Passive managers, on the other hand, they simply aim to track an index. Their fee structures are often fixed based on assets, which means their financial incentive to spend resources on engaging with companies might be quite different compared to active managers constantly looking for an edge.
So, active managers are potentially more inclined to dig into things beyond just the quarterly numbers if it gives them that edge.
Exactly. And that leads us nicely into the concept of stewardship and engagement. Stewardship is really about the fundamental responsibility investors have to manage their capital for long-term value,
Yeah.
not just for themselves, but considering, broader sustainable benefits for the economy, society.
Oversight, essentially.
Yes, it includes monitoring companies and using ownership rights thoughtfully.
And engagement is the direct conversation piece.
That's right. Engagement is the specific interaction investors talking with company management, often about topics like ESG, environmental, social, and governance issues, or even strategic direction. The goal is either to push for changes in company practices or maybe just to gain a deeper understanding of the company's approach.
Got it. Now, focusing on active ownership, a lot of the power there seems to come from information. How do active managers use the information they get from talking to companies?
Well, how they can use that information depends quite a bit on the regulatory environment. In places like Europe and the UK, under the Market Abuse Directive, there's a strong emphasis on parity of information.
Meaning?
Meaning, basically, trading on material non-public information is generally illegal. If a company shares something that's market moving, they're typically required to make it public pretty quickly. Everyone gets the info at the same time, ideally.
And the U.S. approach has traditionally been a bit different.
It has been, yeah. The U.S. has traditionally allowed analysts more scope to gather information through meetings and trade on it, as long as they don't violate a specific duty of trust or confidence, like, say, breaking an NDA.
Right. There was that Einhorn case, wasn't there?
Exactly. David Einhorn, a U.S. manager, was fined by U.K. regulators for trading after a call precisely because the U.K. system has this stricter parity focus, even without a formal NDA in that instance. It highlights the difference.
Okay, so in the EUK context, if the really juicy information is an insider in the traditional sense, what kind of information are they looking for then? What's valuable?
Oh, this is where soft information becomes really important. These are the insights you get from interactions that aren't hard numbers or, concrete reportable facts.
Like judging the quality of management.
Exactly. Assessing management quality, how cohesive their long-term strategy appears, or even subtle cues you pick up in a meeting. Tone, body language, things like that.
Like that striking Carillion example you mentioned before.
That's a perfect illustration, yeah. There's this story about an analyst deciding to sell shares in Carillion, the construction firm, partly based on observations like the chairman seeming unprepared or maybe even being noticeably tanned after a trip.
Seriously?
Yeah, suggesting maybe his focus wasn't entirely on the company's looming issues. Now, that wasn't classic insider information, but it was valuable soft information influencing an investment decision before the collapse.
That is fascinating. So ESG information can also fall into this category of valuable soft information.
It absolutely can. Research like a study looking at standard life investments showed that fund managers did make trading decisions based on information generated by their own governance and stewardship teams.
So it's not just a cost center.
Exactly.
Yeah.
It suggests that stewardship isn't just, ticking a box or a compliance cost. It can actually generate alpha or value for active managers, often by identifying risks that might lead them to sell shares.
And with today's technology, they can even use AI to find this soft information.
That's right. Studies using large language models have basically confirmed that significant soft information exists within meeting notes, and there's a correlation between identifying that soft info and subsequent trading activity by the fund managers. It backs up the idea that these conversations matter.
Beyond just gathering information, how does the actual dialogue part of engagement work? Is it just investors asking questions, grilling management?
Not really, or not always. ESG and stewardship teams specifically are often engaged in a much more of a two-way dialogue with companies. They're expressing concerns, suggesting pathways forward, trying to influence directly.
So it's more collaborative.
It can be. It's often distinct from how a typical fund manager might interact, which can sometimes be more transactional, maybe more focused purely on extracting data for their models.
And I assume how much you own of a company gives you more leverage in these conversations.
Oh, absolutely. The size of your holding is crucial. Larger shareholders typically get better access to senior management and have significantly more leverage in discussions, especially on sensitive issues like, say, executive pay, say, on pay.
Companies want their big investors on side.
Of course, they're more likely to listen and engage meaningfully if a major shareholder raises an issue.
So an active manager gathers information, maybe through these engagements or other meetings, and if they uncover something worrying,
Mm.
like the analyst seeing issues at Carillion, they has a fundamental choice.
Yes, exactly. They're faced with that classic engage or exit decision. If the company is a significant holding and they believe the problem is fixable and they can potentially help, they might try to engage, to push for changes.
Try to fix it from the inside.
Right. But if they conclude the situation is too risky, or maybe the company is unresponsive, or it's simply not worth the effort or the risk to their fund, the decision might be to exit to sell their shares.
Which brings us directly to the other major strategy we wanted to cover, divestment activism. Now, traditionally, divestment just means selling an asset, right? But this is something else.
It is fundamentally different, yes. Divestment activism is selling shares specifically with the goal of influencing company behavior. And crucially, it's almost always paired with very public campaigns designed to stigmatize an industry or specific practices, like we've seen with fossil fuels.
And there's this concept called voice through divestment. What's that about?
Yeah, that term really captures the essence. It's where the announcement of divestment itself becomes the primary tool of influence. The act of selling publicly is framed as a statement of disapproval that aligns actions with words for effectiveness, as one paper put it.
So the selling isn't the main point. It's the saying you're selling.
In many ways, yes. The message isn't just sent privately. It's broadcast publicly to maximize its impact, to shape the narrative.
Okay, this is where the big debate really heats up. Critics, often rooted in traditional finance thinking, folks like Ivo Welch, argue the divestment is largely ineffective. What's their reasoning?
Well, their arguments are pretty straightforward and logical from a purely market mechanics perspective. They say, look, when you sell shares, someone else just buys them, the market absorbs them, so there's no real lasting price impact on the company.
The shares just change hands.
Exactly. Selling doesn't directly force company executives to change their operations or strategy. And crucially, once you sell, you lose your voice. You can't attend shareholder meetings, file resolutions, or engage from within anymore. You've given up your seat at the table.
But the proponents of divestment activism push back hard on this, arguing the goal isn't necessarily direct financial pressure, but something else, something maybe more indirect.
Precisely. They argue the impact is often indirect, but potentially more powerful in the long run. The real goal is often to stigmatize the industry, to shift the social and political conversation around it, and to build a broader movement for systemic change.
So the act of divestment becomes a symbol.
A very powerful symbol, especially when it comes from notable institutions. It acts as a communication catalyst.
Okay, so how does this indirect channel of impact theoretically work? Can we break that down?
Sure. I mean, there's the direct channel, which is the traditional finance idea. Massive sales could, in theory, lead to price pressure, which hypothetically increases the company's cost of capital, which might eventually lead to behavior change. But this requires truly enormous sales and specific market conditions, often hard to achieve.
Right, and the voice through divestment channel. How does that flow?
This is where the announcement is the key lever. You have a public campaign, often using a strong narrative thinking hashtag keep in the ground for fossil fuels. This leads to divestment announcements, particularly by highly visible or respected investors like universities or foundations.
Those announcements get attention.
They generate resonance, they capture public attention, influence political discourse, and importantly, they can signal future regulatory action. That resonance, in turn, increases the perceived systemic risk for the targeted industry in the eyes of the wider market.
Ah, so it changes how the market sees the whole sector.
Potentially, yes. This higher risk perception can then lead to market effects like sustained net selling pressure, maybe a higher cost of capital down the line. The ultimate aim might still be corporate behavior change, but the campaign, the announcements, and the resonance they create can also directly influence companies by damaging their reputation or influencing the regulatory environment around them. It's a more complex pathway.
Okay, let's delve into that major example then, the fossil fuel divestment campaign. What was the core narrative driving that movement? It was pretty powerful.
It absolutely was. The central message was built around this stark idea of unburnable carbon. The concept is simple but really potent. A huge portion of the known fossil fuel reserves held by companies simply cannot be burned if the world is to avoid catastrophic climate change, meaning staying within internationally agreed temperature limits.
Based on the science of climate limits.
Yes, scientists pointed out we've already crossed a crucial threshold, 350 parts per million of CO2 in the atmosphere. Researchers like James Hansen identified that as a critical limit years ago. You can see it clearly on graphs showing global temperatures tracking CO2 levels soaring past that 350 ppm line.
And even public figures like Barack Obama echoed this idea, right?
Yes, he's famously quoted as saying something like, "We're not going to be able to burn it all." The campaign then took aim at specific targets, the so-called Carbon Underground 200.
The top 200 companies.
The top 200 publicly listed companies globally holding the largest potential carbon emissions locked away in their coal, oil, and gas reserves.
And the inspiration for this whole approach drew from history, didn't it?
Absolutely. A key figure in the movement, Bill McKibben, explicitly cited the anti-apartheid divestment campaign against South Africa as a direct model.
Using moral pressure.
Exactly. And people like Archbishop Desmond Tutu also highlighted how international pressure, including those earlier divestment campaigns, played a significant role in eventually dismantling apartheid. The idea was to leverage that same moral weight and public pressure against climate change contributors.
So what was the scientific and economic basis they used?
Well, the scientific foundation for unburnable carbon really came from rigorous work, like a 2009 paper by Meinshausen and colleagues. They provided the initial estimates of global carbon budgets, how much more CO2 we could emit consistent with limiting warming to 2 degrees Celsius.
And then the Carbon Tracker Initiative translated that science into financial terms.
Precisely. Their pivotal 2011 report, also called Unburnable Carbon, took that scientific carbon budget and applied it directly to the reserves held by listed fossil fuel companies. This report quantified the potential emissions from those reserves.
And introduced the idea of stranded assets.
Yes, it really brought the concept of stranded assets into the mainstream financial conversation. The idea that assets like fossil fuel reserves could become economically worthless if climate policies effectively limit emissions. Mark Campanale at CTI is widely credited with originating that powerful framing.
I've seen that diagram comparing the sheer scale of existing fossil fuel reserves against the tiny remaining carbon budgets. It's incredibly stark.
It is. It visually shows this enormous gulf between the total potential emissions from known coal, oil, and gas reserves and the very limited global budget we have left if we want to stay within 2 degrees Celsius of warming. It just showcased the unburnable scale of the problem.
And it listed specific companies holding these massive reserves.
Yes, companies like Severstal, ExxonMobil, BP, Gazprom, showing the gigatons of CO2 potential tied up in their assets.
And Bill McKibben's Rolling Stone article in 2012 was the moment it really exploded into public consciousness.
That article, Global Warming's Terrifying New Math, was absolutely crucial. It synthesized these complex scientific and financial concepts into a powerful, accessible narrative and explicitly called for a broad divestment movement as a response. The illustration with it showing the numbers was very impactful too.
So the campaign wasn't just a general call, it's strategically targeted specific influential institutions.
Yes, very much so. There was a very strategic focus on targeting institutions whose decisions would carry significant symbolic weight and generate that crucial resonance we talked about.
Major foundations.
Exactly. Prominent targets included major foundations like the Rockefeller Brothers Fund, which carried this powerful historical irony given its origins in Standard Oil Wealth, the Ford Foundation, and eventually pressure mounted on the Bill and Melinda Gates Foundation, too.
Universities were also major targets, weren't they? The big names Harvard, Stanford, Oxford, Cambridge.
Absolutely. Universities became key battlegrounds, often fueled by passionate student activism. You remember those images, like the do the math photo from the New York Times protests?
Yeah.
And religious institutions became powerful advocates, too. Most notably, perhaps, the Vatican under Pope Francis. His encyclical Laudato Si provided significant moral authority and support for the movement. The papal coat of arms even became associated with this ethical stance on climate and divestment for some.
Okay, so we have the narrative, the science, the targets. But the big question remains, did it actually work? How do we measure the impact, especially if it's not just about direct price pressure? This is where that Becht, Pajus, Toniola research comes in, right?
Yes, exactly. Their 2025 research provides some really compelling evidence on this. They focus specifically on measuring the resonance of divestment announcements. How much buzz did they create?
How do they measure that?
They did it by analyzing massive amounts of social media data, millions of tweets, looking at divestment-related hashtags like hashtag fossil-free, hashtag divest, hashtag keep it enthroned, to see which announcements really gained the most traction and public attention.
And they found that certain announcements were particularly viral, went way beyond others.
Exactly. The divestment announcement by Ireland's Sovereign Wealth Fund in 2018 stood out as the most viral globally in their dataset. This was highly significant, not just because it was a national fund, but because Ireland had previously been seen as, well, a relative laggard on climate policy in Europe.
And it was mandated by their parliament.
Yes. Crucially, the divestment from the Carbon Underground 200 was mandated by a vote in the Irish Parliament that gave it huge political weight.
Okay, so traditional finance theory would predict that an 11 million holdings spread across 16 stocks, which is tiny in global terms, wouldn't have a noticeable impact on the stock prices of massive fossil fuel companies.
That's precisely what traditional theory would suggest. The Irish fund's holding was, frankly, a drop in the ocean for the global fossil fuel market.
Yet, what did this study find?
Yet, the study found statistically significant and surprisingly large negative abnormal returns for the Carbon Underground 200 companies specifically, right around the time of Ireland's very public announcement.
Wow. And the impact wasn't limited to just those 16 stocks the Irish fund held, or even just the CU200.
No, and that's a crucial finding. The negative price reaction wasn't confined to the specific companies the Irish fund sold, nor was it limited only to the Carbon Underground 200 list. It actually spread across other fossil fuel companies and even spilled over into other carbon-intensive sectors like airlines.
Suggesting a broader market signal.
Exactly. And importantly, this negative effect didn't just bounce back quickly, it persisted, indicating it wasn't just short-term market noise. The researchers also carefully checked and ruled out other simultaneous negative climate news that might have explained the price drops.
So if it wasn't the direct selling pressure from that relatively small fund, what's the likely mechanism causing this broader negative impact on stock prices?
Well, the most plausible explanation the researchers put forward is that these highly resonant divestment announcements, the ones that got huge attention, like Ireland's, signaled to the market a significant and increasing systemic risk.
Not just for one company, but for the whole sector.
For all carbon-intensive industries, yeah, not just the ones being explicitly divested from at that moment. It wasn't about the financial scale of that specific divestment, but the powerful political and social signal it sent, especially a national parliament voting to divest. It suggested the rules of the game were changing.
And that signal seems to align with other big-picture shifts we've seen since then.
It does seem to. If you look at S&P data tracking net zero commitments, there was a dramatic rise in the percentage of global emissions covered by such pledges, jumping from about 20% in 2018 to around 70% by 2021.
A huge jump.
Huge. The viral divestment announcements, like Ireland's in 2018, appear to have acted almost as powerful, forward-looking indicators to the market that this regulatory and political pressure was rapidly escalating for the entire sector. The market started pricing in that risk.
This research really challenges that simple exit versus voice dichotomy, doesn't it? It suggests that divestment isn't necessarily giving up your voice, but might actually be a way to amplify it, albeit differently.
That is a critical takeaway, I think. Publicly divesting, especially when perhaps engagement efforts have stalled or failed, can function as a powerful escalation tool. It sends a clear signal, not just to the company itself, but maybe more importantly to the broader market and other stakeholders, that the company is seen as unresponsive or represents an unacceptable level of risk.
Like some institutions that engage first, but have divestment clearly stated as a final step if things don't improve.
Exactly. The Church of England Pensions Board is a good example. They actively engage with companies based on frameworks like the Transition Pathway Initiative, focusing on climate transition plans. But they've made it clear they are prepared to publicly divest if companies fail to make sufficient, verifiable progress. Divestment is the stick after the carrot of engagement.
But not all institutions are willing or perhaps able to be so public about it, are they? It takes some nerve.
No, and that really highlights the complexity and, frankly, the courage required sometimes. Some institutions might be very reluctant to publicly name companies they divest from. They worry about potential commercial repercussions, maybe losing business from those companies or their wider network of affiliates.
So it's not always straightforward.
Not at all. Which means, for the institutions that do take that public step, it often signifies a really strong conviction and a willingness to potentially face some backlash.
The fact that there's significant organized opposition to divestment must also suggest these campaigns are perceived as having a real impact, right? People don't fight things they think are irrelevant.
That's a very good point. Absolutely. If divestment was truly ineffective, why would powerful industry groups spend significant resources fighting it? We've seen the fossil fuel industry and its allies fund counter campaigns, creating websites like Divestment Facts.
And I've heard of that.
Yeah, reportedly backed by groups like the Independent Petroleum Association of America, using PR consultants. Their arguments often focus on how divestment supposedly harms university endowments or increases student fees.
And we've even seen legislative efforts pushing back in some places.
Yes, particularly in parts of the U.S., there's been a definite move towards anti-ESG legislation. These laws are often specifically aimed at penalizing financial institutions, like state pension funds, that use ESG criteria in ways that might lead them to divest from fossil fuels or other politically favored industries.
So some institutions have perhaps even shifted their stances over time under this kind of pressure, watered down their approach.
Well, some have reportedly moderated their public positions on widespread divestment, maybe becoming more nuanced. Aviva was reported to have done something like that by 2025. But on the other hand, you also have institutions like the Vatican under Pope Francis who, as of late 2024 anyway, continued to be persistent advocates for divestment despite these pressures, really demonstrating that kind of conviction and courage we talked about. It's an ongoing struggle.
So pulling it all together then, active ownership is this multifaceted strategy. It uses diverse information sources, including that soft data, ESG insights, both for making trading decisions and for direct dialogue, trying to influence from within.
Right. And then divestment activism, while it involves selling shares, seems to primarily function through this process of stigmatization and influencing the broader market's perception of systemic risk. It often serves as a powerful, high-profile escalation step, especially when engagement efforts don't seem to yield results.
It really illustrates the creative and evolving ways that investors are finding to exert influence, not just on individual companies, but potentially reshaping entire sectors and markets through their actions, and importantly, the voice those actions amplify.
It's a dynamic space, for sure, constantly changing tactics and targets.
Thanks for joining us today. Until next time, keep exploring.